Hello, and thank you all for joining today. Thank you, as usual, for participating with Family Office Insights. We're grateful for how much engagement we have, and super happy to have you here today. Just a little bit of housekeeping for Zoom. As you all know, we can't hear or see you, but we're encourage and welcome any questions that you might have in the chat box or the Q&A. And we have a lot of people coming on today, but we'll get to as many as we can. And feel free to ask the questions as they come to mind. We have them in the chat box in the Q&A, so we'll be able to get to them. So really happy to introduce a fund that's had not only success historically, but has a unique measuring model, and you'll learn more about it here shortly. So the other thing I would mention to you is that we're going to record this for the record, and we are going to post it to the Family Office Insights YouTube channel. So if there's anybody that you know that would benefit from seeing it, you can go there and share it with them, with your colleagues and friends, and we encourage you to do so. And also, just as you know, we'll be sharing your information with Bud and TrueSpace, so you can connect with them directly afterwards. And Family Office Insights to make sure we facilitate that information. So again, thank you all for being here. Super grateful for your participation. And with that, I'm going to introduce Bud. Bud, take it away.
Thanks, Arthur. To echo that, really appreciate the opportunity to introduce you to TrueSpace, the work we've done, and specifically the fund, which is a debt fund targeted at TrueSpace members. And I'm going to unpack that a little bit more for you so you get an idea why that's important, particularly, especially as it relates to our ability to help these companies reach middle market, which our definition is 10 million recurring revenue. While we're getting going, let me introduce the debt fund team, and I'll give you a little bit of a quick review on what I've done the last 43 years. I'm the managing partner of the TrueSpace Fund. I'm also a very active coach mentor for TrueSpace. So I work directly with about 25 of the 55 companies that are members of TrueSpace. That gives me a direct engagement with the companies, and it's just, frankly, it's a lot of fun. I'm working with a lot of really smart entrepreneurs and business owners. My background has been all in high tech. I've run 5 companies as CEO. They've all been privately owned companies, venture capital, private equity backed. What informs the work I do at TrueSpace and my interest in creating this fund is the experience I've had in running companies in the middle markets and early middle market emerging growth companies, recognizing that when businesses are post startup, that is to say they're at 1 or 2 million, they've typically raised some amount of institutional capital, but they haven't yet made it to at least 10 million. They get in this really weird zone, and a lot of research has been done about it. But what happens is they're no longer sexy. They're sort of pedantic. Their growth objectives are to go beyond living to fight another day to really build a business, and that's the work of TrueSpace. So my work with TrueSpace and with the companies is informed by 5 different times at the helm, successfully selling 3 of the companies. But I ended up, by outcome, not by design, I ended up being one of those CEOs that goes in and figures out what's wrong and tries to fix it and course correct it and get a successful exit for the investors. And so that's a quick flyby on my background. Charles and Jamee Fred are a father-daughter team. They started TrueSpace after Charles sold his last company to Xerox. And these were all middle market companies, and they came out wanting to know, why is it that a very small percentage of companies that make it to 1 million can't ever make it to 10 million? And they looked around, and there really wasn't very much research that informed that question. So they set out on a 4-year journey, which I'll tell you more about later in the presentation. But the punchline is, Charles is the managing director of TrueSpace. He and I do most of the coaching and mentoring. Jamie is a partner in the fund and also the president of TrueSpace. And then Tanner Moylet is the chief financial officer for TrueSpace and is also a partner in our fund. Tanner is somebody that I lean on heavily when we look at the more of the financial due diligence and capital structure of the business. So that's the fund team. And as I'll mention again later on, one of the benefits that we get in operating the fund is that we get to leverage existing resources from TrueSpace, because the work that we do is tightly integrated in with the fund work is tightly integrated with TrueSpace. So let me just do the proverbial, tell you what I'm going to tell you. I want to talk about why we're doing this fund and what has informed the creation of doing a debt fund in particular. And then I'm going to jump in and give you a little bit more context around TrueSpace and the work that informs the investments that we make from the fund. Because as I'll say a few times, to be a recipient of the debt, the loans from TrueSpace Fund, you have to be a member. We have to know who you are. We have to have worked with you enough to know whether you're actually capable of servicing the debt and whether you're capable of building and scaling the business. And the work of TrueSpace is what informs us of that. So let's talk about why. So there's about 2.1 million companies in the United States that are past startup. That is to say, they've raised early round money, friends and family, seed capital, angel money, and they're in this. They've gotten to 1 or 2 million in revenue, but the challenge they get into is they get into what I call a capital no man's land. They need additional operating capital to fund the growth of the business. They quite generally haven't proven the model yet, the formula yet. So going after new capital, banks don't want to talk to them. They're not big enough. Equity-based investors will talk to them, and they'll talk to them with things like, gee, that's a great idea. Come back when you've proven it more. Or for your $750,000 or $1 million, we'd like, 20, 25, 30% of your company. So it's a significant price to pay for the operating capital, which gets them in a position to where I've personally seen in companies I've come in and replaced the founder CEO, where they no longer have a material ownership of the company, because they've sold it all to investors, or they've committed it all in convertible debt and so forth. So there's 2.1 million companies that are in that stage. The other dynamic is the vast majority of them are run by guys that look like me, and there's only about 20% that are women run or operated, and a very small percent that are run by Black owners. And so we're looking at this and saying, and about 400, a little less than 400,000 of them have the capability of building their business to the middle markets. They've got significant potential. So not all of the 2.1 million have the capability of getting to 10 million. That's part of what we flesh out in the work we do with them before they become a member. But a significant number of them do have this. they get stuck. They don't have access. They don't really know where to invest the money to get the biggest growth in enterprise value. And they get stuck in this capital no man land. So that's the target that we're going after, about 370 to 400,000 companies. And we created the TrueSpace Fund out of this need. It's a non-dilutive capital source to bridge these entrepreneurs with operating capital, working capital, to help them reach the next milestone, to help them either reach a $10 million revenue mark or to help them get to where they've got demonstrated capability to where now they know what they would do and how they would deploy and the returns they would get on investor capital coming in, so that an equity round doesn't cost them significant ownership in the business. It's also a fund that's targeted to address the diversity and really help women and minority-owned businesses get access to capital that the data says is really difficult for them to acquire. It's low risk because we know these companies. It's low risk because we will only lend money to businesses that we know have the capability of growing and the capability of servicing the debt. And we know this because to be a loan candidate, you have to have been with TrueSpace for at least 3 months. So it's not just we're using the fund as a way to attract them. It's really a capital source that fills in the second part of the biggest thing these owner operators need. The first one is, how do I spend my time? Where should I invest my time and capital that's going to get the biggest payoff? The second piece is just the capital itself, getting access. So the fund purpose is to really support the growth of these businesses. It's a $15 million aggregate fund, but we're doing it in 5 different micro funds. It's set up as a Series LLC structure. Each of the funds is targeted at 3 million, and each will be thematic. So, and I'll talk about what those themes are in the next slide. Average loan size is 500,000. We will loan 250,000 up to $1 million, but we're expecting that the average loan size is 500,000. They are 4-year fixed term interest bearing notes. They're amortized over the 4-year term, so they pay principal and interest monthly. So there's not a big balloon that they have to choke on at the end of the 4 years. The interest rates that we charge will be in the low double-digit interest rates. So think 10 to 12% interest rates, less than factoring, more than they're going to pay for a bank. But our view is if they can get the money that they need from the bank, then they should go get it. So this is an alternative source of capital for these companies that we know. The 5 micro funds have been set up thematically. The first one is targeting at actually financing the membership fee. To be a member, you have to pay $2,500 a month, $30,000 a year. And we've set up a structure for some of the companies that would prefer to finance it over a period of time. That fund has got a lower threshold, and it is fully subscribed. So that fund is in play, and we are actively working with member companies to finance their $30,000 a year memberships. Series 2, 3, and 4, and 5 are open. Series 2 is targeted at women and minority-owned businesses. Series 3 is a general membership, so it's kind of the all other bucket for current memberships. And then we've purposely kept open the 4th and 5th micro fund, anticipating a desire by investors to come in and say, I like the idea, I want to support these companies, I like the return potential, And I really want to put my money on consumer packaged goods companies or on light manufacturing businesses or whatever it might be. So we've kept it out so that we can, and structured it so that we can structure each of the micro funds thematically with specific investor interest. What's the investor return? First and foremost, there's no management fee. So 100% of the capital into the fund gets deployed. It's an 8% committed return to the investors. It's a fixed rate over the 4-year term. You get monthly payments of interest in your pro rata interest in principal payback. And our commitment is that we will begin paying interest payments, the 8% interest payments back on your money no later than 6 months after you've committed the capital, after the money is in play available. We want to make sure that we're not sitting on money. We want to make sure that we get it deployed, and frankly, we want to get this acted into companies that we know have the capability and have the need. So no management fee, 8% committed return. Think of it as a monthly annuity check, kind of like a real estate investment would be, committed against. And our ability to sustain ourselves is that we'll keep the spread, the interest rate spread. We will also carry warrant coverage, a small amount of warrant coverage, depending on the size of the note. If an investor is committed to at least $1.5 million in any one of the micro funds, we'll share the warrant coverage with the investors. Below that, frankly, we're scratching too little dirt for the amount of the warrant coverage. But we do recognize and we want to incentivize investors that want to come in and support an entire micro fund of 3 million or at least half. The other element of sustainability is the only covenant that we make with these companies is you've got to be a member. And we do that so that we can have first line of sight on the businesses and on their deployment of capital. We want to know ahead of time if there's going to be a problem in repayment. And we sure want to know that it's being deployed in a way that will maximize the growth of the company and therefore the returns on the investment. Final piece is we're able to do this and operate without a management fee because we're leveraging the resources, and I described that in the team before. So we are all of us in the fund active staff on TrueSpace, and so we're able to leverage the time and the capability and the operating expense across TrueSpace and in managing the fund.
Hey, Bud.
Yeah.
Just detail in collateralizing the loan, do you attach revenue or assets or shares aside from the warrants?
Yeah, it's a great question. We the loans will be collateralized by assets of the company, and obviously it depends on the kind of business it is and the business model as to what those assets look like. For software-based businesses, the asset is going to be intellectual property. It'll be very much like, what a bank or structured finance will collateralize. For light manufacturing, it'll be collateralized by both inventory and receivables. The other thing that the collateral base, we are not going to ask for personal signatures of your home. We know by experience that's a sleeves out of your vest. And frankly, I don't want somebody's house if they're going to default. But it's in assets that would be monetizable to mitigate the chances of loss. Second point, the loan. Our loan position will be either senior secured debt or senior subordinated. And we're doing that But one way we can do that is that if there is an existing bank that's got a line of credit or a loan that's tapped out, we can use our loans to recapitalize those and take senior position. And the third point is because it's debt, we sit at the top of any sort of liquidation stack, if, in the worst case scenario. So those are elements that we bring into play. But again, personal experience and having worked with literally hundreds of CEOs over my career and entrepreneurs, owner, founder, entrepreneurs. One of the silliest covenants that people believe are worthwhile is, hey, I'm going to get your personal guarantee against the loan, and we just know that is it just ends up being very counterproductive. So collateral will be based on the business model, based on the type of business it is, and then we're positioning ourselves in the capital structure so that we're at the top of the stack.
So just a quick question related to that. If there was a hardware company and they have IP but no revenue, would they just not qualify for your construct? Or
that's right. Yeah, these aren't companies. This isn't convertible notes in a classic sense of seed capital. These are businesses that have operating revenues. They're throwing off enough cash to service the notes. So they're typically they're going to be companies that are in the mid-range of our membership. They're going to be 3 to 4 million in revenues. And they have to have a demonstration of paying back the notes. So it's not for everybody. We've got 55 companies now that are members of TrueSpace, and about 20%, maybe up to 15 of those companies would be candidates. I've got 3 companies I'm working with right now that if I had the fund available, I'd be deploying capital. But that's it's not for every TrueSpace member. Being a TrueSpace member is a necessary condition, but not a sufficient condition. So we want to support these companies, but we want to do it in a way that's going to provide good returns. The research we've done suggests that we should plan on the number is actually 1.7% default rate for these types of microloans for businesses at this stage. So it's not a significant, it's not the risk level that you would take in as venture, but it's also not the returns. So, we recognize that. But it really is that the goal is to really lower the risk of debt financing and provide operating capital for these businesses. I mentioned the position that we take. We use the 5 conditions operating assessment that I'm going to tell you about now, and the work we've done with Gallup that helps us determine going in the capability of these businesses to actually build and scale. And then we provide, as I mentioned, as a TrueSpace member working with them closely, we provide ongoing oversight, which gives us, pretty strong leading indicators if there's going to be a problem. And as I mentioned, it also, more importantly, or as importantly, gives us the visibility of use of capital and whether they're really getting return on that operating capital investment. So let me shift gears and give you some context about the work behind the work. TrueSpace, as I mentioned, was founded by Charles and Jamee Fred. They embarked on what is now a 7-year study, $15 million invested in this work. It started with 150 companies. $50,000 was invested in each one of these 150 companies for the purposes of research, for the purposes of getting a seat at the table to be able to really understand and track how these businesses operated, what decisions they made, who they hired, who left voluntarily, very in-depth, hands-on research of 150 companies. Over the 4-year period, this was 2014 to 17, the 3 of the companies flamed out. So these are hand-selected companies, and 50,000 put in a little bit of seed capital, mostly seed at the table, and 3 of them went out of business. 14 of them far exceeded from a growth and performance capability, far exceeded the rest. Exceeded meaning they grew at 25% a year over the 4-year period. They started in between a 1 and 10 million in revenue. They exited at an average of north of 30 million in revenue. And 133 of them kind of bumped along. 133 didn't have, impressive growth, 5 to 10%, kind of, stayed in that no man's land. So they took the research and a part of the way they studied the companies had 2 important characteristics. They approached it as a science experiment. One was they used ethnography, which is the science of interaction between humans and machine. It's the work that Steve Jobs did to come up with the mouse at Xerox Palo Alto Research Center. But ethnography, it allowed Charles and Jamie to not only see how the team operated within themselves, but how they operated against the business. And then the other, so that's the ethnography. The other work that they used was based on a methodology called system dynamics, which was created by a professor at MIT, a guy named Jay Forrester. And system dynamics is a critical element to our work because it is what allows us to measure the capability and measure the work of these companies. It's a closed loop systems that measure stocks and flows. And let me take a minute just to tell you what the heck this means. Imagine that you've got a glass and you want to fill the glass with water. The glass is the stock. It's the vessel, it's the container. The water is a flow or the value that goes into the stock. And the control mechanism that makes it a closed loop system is you as the person pouring or controlling the flow into that stock. Without a control mechanism, it's an open loop system, which is why these companies that don't measure and manage their business in closed loop systems have no way of really effectively tracking what are they learning from the business, or is they're just pouring money, right? So that's one of the principal reasons through the research that was identified as to what happens to seed and investor early stage capital. It's because they're pouring water into a glass, but they're not really controlling the flow. And so, you run out of money, it overflows. So that's a simple example of a closed loop system. The control mechanism being the operator, being the person that is determining the flow of the value into the stock, and the one that's tracking the measure, how high is that water going into that stock. We used ethnography and we used system dynamics as a way to measure and track and develop the work and the outcomes of the 4 years. Oops. From that, we created a construct that we call the 5 conditions framework. All the way on the right are the input values. These are the water flows, if you will, my examples. So these are the values that we measure. The values then go in and feed into 12 different stocks: focus, mission, structure, accountability, governance, measurement, assumptions, versatility, revenue and sales, engagement, benefits, and enterprise value. Those are 12 stocks that are closed loop systems in our methodology that we work with these companies on to measure, are they getting payback from the values being put in. Those 12 stocks then make up 5 operating conditions. These are the operating conditions that existed consistently in the 14 companies that outperformed the 133. The work then this framework was taken to Gallup, and Charles and Jamee paid Gallup to take their work against 147 companies and put it into Gallup's database of 2,500 companies, with the goal of validating or invalidating the work, with a much larger database. And Gallup came back after their work, and they said, not only is it validated, it is the highest reliability score of any assessment tool that we've built since Strength Finders. It's got a 0.876 correlation reliability score against their benchmark. Gallup's benchmark is 0.7. So it's came back with high predictive value in determining the capabilities of these businesses to get to the middle markets based on assessing where they are against each one of these 5 operating conditions, right? And so they created an assessment tool that's got 97 questions in it. The 97 questions feed into these conditions, as you can see here. So 31 of the questions are related to alignment, 20 go into discipline, 24 into predictability, and so forth. This is the assessment tool that we use at the beginning of an engagement with our members to determine, do they have the capability of building their business into the middle markets? The research that's been validated says that if they can build the shape and the capability of your business in these 5 conditions, they've got a 300% greater chance of getting to the middle markets, of getting to at least 10 million in revenue. Interesting other elements to this. The work came back and said that it's a totally blind assessment. It turns out, much to the chagrin of a lot of academia, it doesn't matter whether the owner operator, the executive team came from an Ivy League business school or went to college at all. It doesn't matter their ethnicity, their gender. What matters is, do they as a business have the conditions of growth and the conditions of scale? The other thing that's interesting is it's very clear from the research that the single biggest indicator of enterprise value is predictability. It's not grow fast, get big, scale quickly, first mover advantage, none of that stuff. It is, can you build a predictable business? And that is the single biggest determinant of building enterprise value. So that's what we work on with these companies. Couple of screenshot examples of what the assessment then gives us. It's a radio image. It tells us against the way the executive team answers the question. So it's their optics of the capability of the business, where the company lands on an aggregate. So 0 to 53 is in a zone called emerging. 54 to 63 are companies that are in a stage called remodeling. And then above that are the benchmark companies. There are about 80% of the companies we work with are in the assessment that are in the emerging. That means they mostly have characteristics of a startup. They're still trying to figure out, where they best fit in market, in customer, in value proposition, so forth. There's a narrow band that shows evidence of scale. And about 15% of the companies that take the assessment operate in this band. And then about 5 or 6% are actually operating in the benchmark. What's important for you as a potential investor in the fund to know is for a company to get a loan, they have to be operating at least in the remodeling. If they're operating below remodeling, the capability is still too unpredictable to know whether they, on a probabilities basis, whether they've got a chance of building and scaling the business. So that's another condition that we use. We take the assessment, we get the data down to each operating condition level. So we can see how does the team rate the capability against the condition called alignment. Alignment is informed by the question, does this business have the capability of growing? Can it grow? Discipline is, does it have the ability to scale? By scale, we mean, can you derive a greater and greater contributed margin from each new unit of value you're delivering out to your customers? So it's a contributed margin based measure. It's all around efficiency and predictability. Predictability is the question of, are the decision makers learning from the business? That's how you become predictable. The endurance condition is, do you have the resources, talent, and stakeholder engagement for the long haul? One of the things that came out of the research is that, unlike common wisdom, businesses that make it to the middle markets take about 12 or 13 years to get there. It's not an overnight deal. It takes much longer than most entrepreneurs and investors want to believe. And then value creation is exactly as it implies. Are the work that you're doing and the results you're getting driving enterprise value as would be measured by somebody that would come in and buy the business? But we get the assessment from the team at this level, and we also get an image that's not unlike radiology. The purple in this diagram is the shape of the business as perceived by the executive team against those 12 closed loop systems. The gold band is a set of 120 companies that Gallup refreshes about every 6 months for us. And it's a reference base. They're all companies that are the aspiration of TrueSpace members. These are companies that 4 years ago were between 1 and 10 million. They grew consistently at least 25% a year over the last 3 years. And they're now operating in an average of 32 million in revenue. We have Gallup refresh the reference base for us because it changes. And you can see by the width of the gold band that even benchmark companies don't operate fully out against all of the closed loop systems, all of the systems. But we use this as a reference point for our work. Then what we do when a company comes in, first thing we do is determine, do they have the capability of growth and can they scale the business? And we look at the assessment scores that we get and to make that determination. If they want to become a member, they engage us for a minimum of 12 months, and we begin working on the space between the shape of their business and the benchmark. And there's specific inputs to each one of those that I showed in that earlier framework. So that's the work we do. We're also able to see.
Yeah, Bud, hang on 1 second.
Okay.
Can you go back to that? Just because there was a question.
Oh, yeah.
That was relevant to this slide. How applicable is the reference band with smaller, earlier stage companies, even though that's not your target?
Yeah.
It's an interesting question.
It is an interesting question. It turns out it is very applicable. Because what the band tells us is the operating range for companies that are in that have reached the middle markets and that not too long ago were early stage developing companies. Now let me add a little bit more color to that. One of the reasons that we don't work with startups is because they haven't they don't have enough history to really get a pattern match to know how they would best apply. There's a couple of things that I think are informed by this that are kind of interesting. One is the shape of the business determines exactly the output you're going to get from the business. So every business produces exactly the output that it's designed to produce, and that's the shape of the business. So we know that if you want to change the output, you change the shape. Second thing we know is that business building is fundamentally different than business starting. It's one of the difficult transitions that owner entrepreneurs have to make, and some of them just can't make that jump. As an example, when you're in a startup, you are in heavy experimentation mode to figure out where exactly is the product market fit. Where does your service offering or your product best fit a market? And so you're experimenting. You're doing by design. You're trying a bunch of different things. When you're in build the business mode, which is where we are, you have to do exactly the opposite. You have to focus. You have to reduce the aperture down to high value customers. And we've got explicit descriptions of what that means. And you've got to reduce your market and your target segments to where you're going to win 80% of the deals you go after. Another myth that was blown by the research. Most businesses throw away a lot of money because they're throwing a lot, the marketing spend goes way up. They do, SEO work, AdWords, if it's a consumer-based deal, they're throwing a lot of money at marketing. They're not effectively measuring the results as it relates into unit value, unit economics, the cost to acquire, the cost to deliver. And as a result, they get very fragmented. So the work that we provide, which is different than a startup, is look at where you've been and target your business where you have won a high percentage of the deals you've gone after. Don't go fish in a pond and hope you get a small percentage. Go target specifically where you've had a high percentage of wins, focus your business, build momentum. And once you've captured a large share of that target market, then think about going to the next stage. But back to the question, it's a very relevant benchmark. The capability of a business to really operate and move and focus is determined by the stage of the business.
So, like you said, one of the highest or most important metrics is predictability. So once you've been able to demonstrate that you can execute on something that produces results, then at that stage of in contrast to a startup, you're focusing on the predictability of executing.
That's right.
Yeah.
That's
so
right.
I want to sneak this question in real quick, and I'm going to interpret it maybe the wrong or the right way, but let me do it both ways. The question is, how does the role of the banker or an intermediary work with the fund to get consideration, which I think is deal flow related, but answer it as a result, as it relates to the purpose of this call, which is, is investor related as well.
Yeah. So the fund is set up so that we get an ability to deploy the capital against the businesses that we know and that we, have been able to do our own due diligence and underwriting on the loan. The investors will get a quarterly updates on all of the investments from the fund. So they'll get regular investment communication. Certainly, for each of the micro funds, the investors will get, where are we deploying the money, and how much of it, and sort of you'll get all that visibility. These companies report, as a minimum, P&L, balance sheet, cash flow statements, and so the investors in in that particular fund, we'll get visibility to what's happening in the business. Going into, and again, this gets back, if you're an investor in a fund and you've got at least half of the fund, we will open up the opportunity to review prospective investments. We're not going to do that blanketly because that's part of the fiduciary responsibility for the partners in the fund. That said, the fund committee, the investment decisions are made by the four people that I showed earlier: myself, Charles and Jamie Fred, and Tanner Moylet. So that's the work that we're gonna be doing, and we rely on fairly traditional financial measures. The flavors that we're able to overlay is where are they in their operating condition, in their assessment of the business, and that we've worked hand to hand with them, for at least 3 months.
And the deal flow is, I think part of the question was if there was a company that this banker or intermediary was interested in introducing, is that something that you look at, or are you sourcing them all in your own way?
No, we would look at them first as a prospective member of TrueSpace. If an investor or a banker said, "Look, I've got this company that is, I think a good candidate," we would have them take the assessment, and as a minimum, you get visibility of their assessment of capability. You get an output like you're showing here. You get the score. They would only become a candidate for money if they became a member of TrueSpace and we were able to work with them for at least 3 months. But our deal flow, principal deal flow, are members that we have or members in the future that we're working with, because it's our single most tangible risk mitigation. and as I said before, we view this fund as an alternative source of capital. Many companies today we're working with are getting SBA loans. They're getting economic disaster loans from the government, which is incredibly cheap money. I mean, it's 500,000 to. I've got one company that's qualified for 1.7 million, and they're paying, it's 30-year 3.24% interest rate, right? So our view is, hell, if they can get the money that way, then go for it. Not all of them can. So
what percentage of, you may not want to disclose this, are there 55 companies that are in TrueSpace and half of them are potential qualifiers or have qualified for loans? Or is it really operate as a separate business and they may or may not need loans from the fund?
May or may not need loans. Of the 55 members, about 15% of them are even candidates. And as I said today, right now, so we're adding our cadence over the last year through COVID, all the rest of it. Our cadence over the last year has been about adding about 4 to 5 new members a month. So we're continually adding our flow. We're adding on other people like me to be mentors and coaches so that we can scale the business. We train them up and onboard them specific to the 5 conditions operating model. But that's our ability to build the business. But our deal flow, as I said, is comes from investor groups. They introduce companies to TrueSpace. We've got investor groups that have contracted with us to use the 5 conditions assessment as a decision tool, not so much to put first money in, but to put follow-up money in. I've got this portfolio company. I'm invested in it. They're going out for another round of financing, and I'd sure like to know another element that's the capability of the business against this assessment tool. So we source companies into TrueSpace on that kind of a network and members, other members that reference in other business owners that they know.
Makes sense. So is there more slides? Because we're going to run out of time here.
Yeah, I just wanted to show a couple things. One of the things that we get as part of the data is the alignment of the team that takes the assessment. This is critically important to identify where are there gaps of visibility or knowledge of the business or understanding. That's part of the work we do. And then we're able to take it down, as I mentioned, we take the assessment scores all the way down, because the important work is, do you really understand who your customer, how you define your customers? Do you understand, do you have strong enough capital source? Do you know why you're in business? So our work really is informed by the raw value and input to get there. But at the end of the day, we exist to increase the confidence of the entrepreneurs to build their business to the middle markets. The purpose of the fund is to provide that level of capital resources that they need to get from where they are into demonstrated growth, into and approaching a benchmark stage, so that so that they've got the capital resources that they need right at a time when they're trying to build their business, which is typically right at a time where nobody wants to talk to them. You're going to get the deck, I guess, right, Arthur?
Yeah, I'm going to send you the list, and you can send it to everybody.
Oh, okay.
I mean, I want you to send it to me if you don't mind, but it's best that you do it directly. Yeah.
I'm happy to do that, but so this is how you can find us if you're interested. And obviously happy to go through one-on-one and into more depth on what we're doing, but I really appreciate the chance to give you the overview and the introduction to the work that underpins the reason we're putting together this type of a fund.
Yeah, it's super, super interesting, and science works, right? Very, very interesting. Well, really glad that you could share this with everybody. Like I said, I'll make sure that everybody gets, you get everybody's information. You can send them the deck and follow up as appropriate. And I thank you for doing this today.
Yeah, really appreciate it. Thanks everybody for wherever you might be.
Yeah, exactly. So once again, thank you, Bud. Really, really fascinating stuff, and super glad to share it with the community. And as always, the Family Office Insights community, I thank you for sharing with us the only thing you can't make more of, and that's your time. Till next time, thank you.
Okay.
Bye.
Bye.